All right, guys, let's begin our panel discussion, GM, and today we're talking about the institutional perspective of RWA adoption. And the real world assets are increasingly making their way onto the blockchain networks, and institutions are choosing to monitor these opportunities and challenges that come with this innovation. And today we have a stellar lineup of experts to share their insights on institutional appetite, their risk considerations, liquidity, and regulatory landscape, of course. So, welcome our panelists today. First, we have Pierre from TrustWallet. Hi, Pierre. How are you?
Hi, Anastasia. Thanks for inviting me. Just to give a little bit of context, my name is Pierre. I'm currently leading the head of BD at TrustWallet. Of course, RWA is something we are paying some attention, and happy to discuss that subject with you today.
Awesome. Thanks for joining us today. We also have João from Mystic Finance today here with us. There we are. Hope you're hope you're joining here now. Passing on the microphone over to you. Hi there. Mystic Finance.
Oh, sorry guys, my sound broke. Didn't realize you were talking to me. Hello, very nice to be here. Pleasure being here. Thanks for hosting. I am the founder of Mystic Finance, and very excited to speak all things institutional about RWAs.
Thank you so much for joining. Pleasure to have you here on this space. Then we also have Artem with us today from Diffuse Protocol.
Yeah, hey guys. Hey Anastasia, thank you for calling. Yeah, Vadim, founder of Diffuse, and like what we actually do at Diffuse, we're trying to enable trustless interoperability for whole Web3, and I hope it can happen one day. Yeah, and we're here because right now we can deliver some data from Web2 to Web3. The trustless money, and it will be interesting to discuss it. Thank you so much.
Thanks for joining, Vadim. We also have here today with us Nadim. Nadim?
Hi. Thanks for having me.
GM, thanks for
Yeah,
joining.
no problem. Just a bit of an intro. I'm Nadim, co-founder of the Y Protocol ecosystem. We're a fundraising ecosystem, mainly focused on primary and secondary markets. And I will tell you more if you DM me.
Awesome. That's a hook to leave. Thank you so much, Nadim. Welcome to this panel discussion. Guys, let's straight dive into it. And we'll start with the institutional appetite before moving into risk, liquidity, and other key areas. And I'll be addressing questions to every single one of you. However, you are more than welcome to follow up to other speakers' question if you've got something. Please, if you have any point of view that is different from a previous speakers, you're more than happy to voice it. We love a good discussion. We love polar opinions. We like finding the truth that lies in between. If you'd like to follow up, please raise your hand. You can find a hand emoji down in the panel below. All right, so let's start with the big picture and how are the hedge funds, family offices, and institutional investors currently viewing the RWA market? Are we seeing any significant capital inflows yet? Maybe Pierre can start this question.
Yeah, sure. My understanding on that right now about the institutional and the RWA markets, if you are considering hedge funds, family office, asset managers, all of them are right now looking at RWA based on the discussion we had. But it's more kind of a cautiously exploration they are conducting. It's a very new market. Everything is very early stage right now. The interest is increasing on their side because they're understanding the potential benefit for them about the efficiency, the transparency, and the higher return they could get from that. But right now, there is also some limitation on their side who make the exploration kind of limited right now, mostly because the regulation is still uncertain on an institutional level, and the infrastructure or the protocol, everything is pretty new, and this is also a risk. So I would say, yes, institutional are looking at RWA, all the new markets. We can see some new inflow starting, but I'm not sure we will have a big boom in terms of inflow for RWA this year. considering how new the market is and how uncertain is the regulation and the tooling, the infra we have right now on that. So that's just my 2 cents on the question.
Thank you so much, Pierre. Guys, let's move on to the next question. Maybe Mystic Finance can help us answer it. So risk management is critical for institutional investors, but what are the biggest risks that they're considering when investing in tokenized RWAs, and how do they compare to investing to traditional assets?
Yeah, a great question. I think this is very much tied to what Pierre just talked about on the institutional appetite. I mean, I think the truth of the situation is it's very hard right now for a traditional asset manager, Web2 hedge fund, what have you, to participate because there are, number one, regulatory risks at place that scare them away a bit, right? Like, things are getting more clear now from a regulatory perspective, but it's always an issue for sure, and particularly because DeFi in general is not compliance heavy, so to speak. So for them to just go into, they would need a platform that is compliance enabled and that is focused on solving for that, right? They cannot be in any point touching, for example, they would need to know what their counterparties are, right? They could not be touching non-KYC users, arguably, right? So they would need that level of, that's from my perspective, from now and from the conversations we've had as well. And so for context, we're doing a lending market for RWAs. We're trying to bring DeFi to tokenized assets. So this is very much our wheelhouse, and we explore these conversations obviously because we'd love to become that environment where these traditional funds could deploy in. So it's interesting for us to see what their requirements would be, right? And so one is definitely the regulatory risk, and I would say maybe the biggest one, right? They're very used to facing securities law. And so that's kind of which is obviously very strict, and that's kind of the gold standard they're abiding by. Second one is they want, in an ideal world, capital protection, like principal protection. Like the issue here is it's going to be very hard for them to justify losing money due to smart contract exploits, because the biggest thing is they are not familiar with smart contract risk, right? That's arguably the biggest problem. Well, regulatory risk in my eyes is the biggest problem, but that's a big one. And so you would also need some way to circumvent that, or at least make them comfortable. And I think that's also difficult, right? Because that comes with time in the space, with understanding the risks involved. I think a lot of us here will be comfortable with Aave, for example, but if you've never heard of it, it's going to be maybe harder, right? So I think maybe just that's kind of our perspective on the situation. You need to get them comfortable with these risks and create an environment where particularly the regulatory risk is reduced.
Understood. Really good points. How long do you think we'll need to wait until we gather enough historical data for them to assess the long-term risk and reward?
Yeah, I have no idea, to be honest. That's a great question. I think you're seeing increased interest now, and that's great. And the more they dive into these products, the more comfortable they'll be. And I know that there's from what I know, and maybe others here can confirm, I think there have been already like more traditional asset managers deploying, right? So there is a history. It's just not like the big boys are under a lot of scrutiny, right? So it's harder for them to come in, but the rails are there. Maybe we just need to like make it more accessible.
Thank you so much. Y Protocol, I've got a question for you. One of the key promises of tokenization is improved liquidity, but does it genuinely enhance market depth for institutional investors, in your opinion, or are there still concerns about these exit strategies?
I mean, by definition, it does, right? But if you tell me at the moment, I will tell you I have no idea. I mean, because a lot of the capital now is coming into the ETFs, into the big Wall Street firms. I mean, we're talking about BlackRock, and we're talking about billions and billions and billions of dollars. So to tell you the truth, now we're kind of in an unknown stage in the industry where, you have, let's say you have a wonderful idea, you don't necessarily have to tokenize it. There are other ways to make it profitable rather than tokenizing it and doing it through the quote unquote liquidity that we know about in the industry.
Thanks a lot. Vadim, I have a follow-up question to you. Do you think secondary markets for RWAs are developing fast enough to support these large institutional trades?
Good question, but I think my problem is that I cannot understand that. I mean that I'm not the right person to ask this question. I'm more about technical infra that can provide it, and like actually cannot track the exact numbers around the markets at all. Yeah, sorry.
No worries. Does anybody have an opinion on that, guys?
Yeah, I mean, I think if I may weigh in here, like this is arguably the topic of the conversation, right? Like this is the biggest thing holding RWAs back, in my eyes, from getting them more connected with DeFi, is that you just don't have enough secondary liquidity to support a lot of the stuff we're used to, right? So, for example, in our case, we're doing a lending market, right? If you have no DEX liquidity, it's hard to, you can't, like all existing money markets liquidate via DEX liquidity, right? So these are serious barriers, right? And honestly, in my eyes, I don't think it's about, obviously it's about maturity, but I also think it's about innovation. Like we have to understand that this is just a new asset class, right? Up to a certain extent, and we need rails that support it better. And you need to, yeah, just build for that absence of secondary liquidity, which I'm not sure is going away. That's really the biggest thing, right? RWAs also are not new, so that's what we got to consider, right? If these assets are intrinsically more fragmented, intrinsically more illiquid, you have to solve for that. You know, I don't think it's a waiting play. So, for example, for us, instead of waiting for DEX liquidity, we split money market supply into senior junior tranche, and if there are liquidations, we can handle them by basically having junior take the liquidation, right? So it's a new mechanism, but enables us to make RWA backed loans in a way that Aave, whatever, could not. So I think this is more the world we're going to be seeing, RWA primitives. But hopefully, yeah, we get to a point where there's enough maturity that this stuff's not needed.
Thanks a lot. I think Vadim has a follow-up for you.
Yeah. Actually, from technical perspective, I think that it's right time to invent new instruments, and that's something which I think in Diffuse to do. I mean that too. I mean that João was absolutely right around the. I mean that lack of liquidity, of liquidation, and so on. And like maybe sometimes it makes sense to aggregate the liquidity in some other instruments, and that can be available on the market. And also this implementation will allow us to do more extra stuff with the array assets that can be tradable on any DEXs, for example, or usage for will be used as collaterals for lending protocols. Yeah, that's my heading here. Thank you.
Thanks a lot, Vadim. Pierre, let's go back to the regulatory environment. Are we seeing any jurisdictions that are taking a super proactive approach to RWA regulation? I mean, we can also, of course, talk about US, which is kind of a stationary one for setting up all the rules, but maybe you're seeing some other jurisdictions that are more keen on hearing more about RWAs.
I might not be aware of the up-to-date regulation. I would say that the main issue right now it's how to handle the ownership of the underlying assets. Basically, with RWA, you are bringing assets on chain. The issue is that you are potentially also bringing the ownership of the assets. I think the key value of RWA, it's mostly to bring the yield of the underlying assets on chain. Most of the people, when they're investing on something, they don't really care about the ownership. What they're interested in, it's mostly what's the yield, what the financial opportunity. If you're buying a stocks, any stocks on the market, most of the people who are investing it, it's not to have the ownership or the control on the company. It's because they are considering, I might have a good yield, I might have a good payout for that, or the speculation might be positive for me on the long term. So I think on the short term, the easiest way to avoid complicated regulation might be to find a way to split the yield from the ownership to kind of bring more liquidity on that RWA market.
Thanks a lot, Pierre. You've got one follow-up from Vadim.
Yeah, sorry. I actually not totally agree that users don't take care about the privacy. Like otherwise, the Web3 market is not existing in all in general. I think this value is very aligned, and like yeah, in general, if you just avoid saying this, you'll be much better. No, I mean that like I think that it's still important, and there is something that nobody can guarantee in the Web2 world. So the privacy and the true ownership of the things. Yeah, and yield is important.
I'm not talking about privacy. The fact about splitting the yield from the ownership of the assets doesn't mean you're lacking of privacy. Let's say you have a company doing RWA on real estate. I'm living in India. I want to invest in the US stock market. I mean, the US real estate market. It can be complicated right now in the TradFi world. Having, for example, some real estate property tokenized on chain where people could enjoy the yield of the investments. Because if they are investing in the US, most of them, it won't be for being the final owner of the house or the apartments. That was most my point about they want the opportunity of getting the yield from the housing market in another country without having all the complication from administrative point of view. So that was most my point.
Thank you so much, guys. Let's develop more on this topic. I'd like to ask Mystic Finance. In your opinion, do you think RWAs are primarily being used for yield generation, or are they more attractive for diversification?
I mean, I think it's yield generation for sure. I mean, diversification is definitely a factor. I think that's a great question. To be honest, all the conversations I've had around it, I've not really seen people mention diversification as their primary reason. I think obviously what you've seen, I think that's obviously a factor, right? And arguably like the biggest factor. Just I think people go where the yield is, and I think the narrative's super strong, and I think people are bullish that this is the play. If I'm being real, I don't think. I mean, at least maybe a more institutional basis, but I think people are looking for, just returns associated with the narrative up to some extent sometimes.
Thanks a lot, guys. The next question I'd like to address it to both Vadim and Nadim. Guys, what role do custody solutions, compliance frameworks, and interoperability standards play in encouraging this institutional participation? I mean, they play a massive role in the institutional adoption. What's your opinion on that? Maybe Nadim can go first, and then Vadim can join him.
Yeah, sure. I mean, there's two sides to that coin. There's the negative side and there's the positive side. Depends on jurisdiction. Like, for example, the EU, for example. I mean, I was in Davos a couple of weeks ago, or a couple of months ago, and I saw the amount of crypto people and Web3 people coming in with their projects, and they're super excited. They're like, yeah, we want to build in Switzerland, we want to build in Europe. But then on the other side, there's the EU putting in all these regulations, which, I mean, it all depends. There's regulation that is good, there's regulation that is bad. It all depends on the fine print, to be honest.
Thanks a lot. Vadim?
So as for me, like we actually more focused on the true Web3 values. I mean, the right place when we build in the protocol as a core values, and that means that custody is not very. I mean that it's not a good solution in general. So I mean that like trustless interoperability, that's something that can remove custody solution and all as actors, like in the end. But regarding the Nadim saying, so the regulatory is the things that available RWA on chain, and I think it's the good intermediate actors that can like spin and like turn on the technology and yield farming from all two different industries.
Thank you. Really good points here. Guys, the last question of the panel that we have prepared, I'd like to address it to everyone. So if you have, if you want to answer it, please raise your hand. We'll be happy to hear your opinion. So many institutional investors, they've got the ECG mandates. So how do tokenized RWAs fit into sustainability and responsible investing frameworks? Oh, that's a tough cookie.
Guys, not everyone at the same time, guys. Come on.
Like, can you repeat the question a bit? I didn't get it.
Yes, of course. We're talking about the ECG mandates that institutional investors have got. So the question was, how do tokenized RWAs fit into the sustainability and responsible investing frameworks, if they do?
Well, actually, it works quite well, honestly. And on a practical level, I mean, as the White Protocol, we're actually investing in a project that fits in this mandate. That is tokenizing trees in South America. So, I mean, for certain projects it works. For certain projects it doesn't. It all depends how they tackle the regulation and if they can make it work.
Awesome, sounds cool.
Yeah, maybe adding a bit on top of that, I think it comes. I think it's really good because it brings, from one side, I think it brings transparency that lacks in certain current registry models. So speaking of carbon, for example, carbon accounting is notorious for being very opaque, and there are a lot of problems and lack of trust associated with if the reality of the carbon credit you've bought mirrors the credit. So for example, you buy a carbon credit associated with a hectare of land in Brazil, the credit still exists and circulates even if the land's been burned, for example, right? And there are dozens of examples like this. So blockchain can obviously help in increasing the transparency and the traceability of this situation, basically. And I'm speaking just purely from a technological perspective here, not really crypto, so to speak. If we're thinking crypto, then I think you unlock the financialization of these assets, right? So we've, for example, experimented with carbon-backed loans, and I think we will again. I think there's definitely a play there. You can democratize investments in asset classes that right now aren't easy to access, like solar energy and more gated / difficult to access asset classes. So I think there's a lot to do in both worlds. But like I think, if I'm being honest, transparency plays a bigger role here than arguably the financialization.
Awesome. Guys, as the last part of our discussion, we normally like to pull up a crystal ball and ask this question. What are you expecting in the next 5 years, maybe 3 to 5 years? What needs to happen for the mass adoption of RWAs? Just your points, maybe quick blitz answers.
I think everything basically we discussed today would be kind of a good summary. From my perspective, I don't expect kind of a mass adoption this year. Maybe more something around 2, 3, maybe even 5 years, just to get all the sector becoming more mature. I think we still have a big dependency on the infrastructure, on the standardization of the protocol and the interoperability between the chain and the solution to kind of remove the risk of fragmented liquidity, as we mentioned. I think the regulation also needs to evolve on most of the jurisdiction to make institutional investor more comfortable with that. So yeah, this would be kind of my kind of thoughts.
Can I say something?
Of course, go ahead.
Yeah, to answer this question, I think the future needs to be, first of all, scaling current successful RWA projects and infrastructures rather than diluting it with new projects and new infrastructures that do exactly the same thing as the ones that are currently there. And I think this is actually the problem with the whole industry as a whole. There needs to be, effort put into the infrastructure that's currently there instead of just, new things that are the same as the previous ones.
Makes sense. This is a really good point. Diffuse protocol?
Yeah. So as for me, the truth is that nobody knows what actually can happen, because like black swans is always appearing, especially in Web3. So it means that maybe the next huge protocol will come out and say, oh, we are very focused on RWA, and we take all the regulatory job will be done from our side. In this case, as for me, like technologically, we're absolutely ready to serve any Web2 data to Web3. and like to provide the right solution as infra. But I mean that it looks like that it's quite obvious that some of the products can appear on the market and be this one that I'm talking about the regulatory and responsibility part. And we as Diffuse will be hopefully serve if such protocols will appear. Yeah, thank you.
Thank you so much. Anybody else wants to follow up on this question?
Yeah, maybe just giving my 2 cents here real quick. I think it's a combination of, like Pierre said, everything we've discussed here today. If I had to say 2 things, it would be the familiarization with risk, so that they can have institutions can have a more informed perspective and are closer to deploying, arguably, and primitives that solve the secondary market liquidity, which again, I personally think is the biggest blocker right now. So yeah, we're trying to do our bit in implementing infrastructure for lending. Hopefully other people can help in other ways. Yeah, excited to see this roll out and how this plays out over the next few years.
Thank you so much. Before we wrap up, I'd like to ask each panelist to share either one key takeaway from today's discussion or a piece of advice for institutions exploring RWAs. Let's send it out into the world. Hopefully they'll hear us. Pierre, maybe we can begin with you.
I think the main takeaway is having the industry focusing on what's depending on us. So I would say to build high standards, to fix the interoperability, to solve the fragmented liquidity for RWA market to come on chain. I think that would be my takeaway for the audience and the potential builders, speakers, and people listening us. So yeah, try to solve the current issue, the main blockers, and then the rest will follow from my perspective.
Thank you. Vadim?
As for me, the great takeaway that the technology by itself, it's cool and enable new possibilities on the market. And like regulatory is the most problem on the space, I think, in general, because like as for us technical guys, it's not a problem to solve this kind. So I mean that it logically can be solved in some essential established regulatory. Thank you.
Thanks a lot, Mystic Finance.
Yeah, I think we're all on the same page. I think it's really about not focusing on what you can't control. Let's build the best infrastructure out there for when other people come and seriously assess this, see that all the pieces are in place. And until then, there's a lot of work that can be done already in RWA 5, so like a more DeFi native RWA, and we can do a lot of work there as well.
Thank you. All right. I'd like to thank all the panelists for their time and expertise that you guys have shared here today. And thank you to our audience for joining us. We'll look forward to seeing how RWAs continue to evolve and reshape the institutional finance. And I'll see you here next week with a different topic on RWAs. Hopefully it's going to be just as exciting. Don't forget to tune in. And once again, thank you so much for this discussion today.
Thank you.
Thanks, guys. Thanks for
Take care.
Thank you for organizing the panel.
Thank you. Bye-bye.
Bye.